Welcome, everybody, to the SNN Network Canada virtual event. I'm your host, Robert Kraft, and thank you all for joining us today. I'm pleased to bring you our next panel for our event. This panel is titled Going Public in the U.S. from an Accounting Perspective, and it's being hosted by co-chair of the SEC Committee at Friedman LLP, Neil Levine. With that, Neil, take it away.
Hey, thanks, Robert. Nice to be with you again. Good afternoon, everyone, and welcome to SNN Networks Canada virtual event, Going Public in the U.S. and Accounting Perspective. I'm honored once again to be the moderator of another SNN event. Friedman LLP has been the lead sponsor for SNN for the last 7 years or so at their virtual conferences and their in-person conferences. First off, I'd like to thank my esteemed colleagues who I've been fortunate enough to discuss the current events that are happening as it relates to going public in the U.S. and getting over this pandemic that we're in right now. Each of the panelists in a few minutes can have a few minutes or so to tell us about themselves, their special areas of practice, and their firms. I'm Neil Levine, co-leader of our SEC practice since 2014. We are an accounting firm of over 600 employees, formed in 1924, some 96 years ago. Our SEC practice has grown to number 12 with the amount of registrants we service. We handle public companies on all the national exchanges and the OTC Markets Group. We also audit private companies that are contemplating going public. We have a large international presence as we are number 4 in auditing US-based registrants with China entity operations. We are also part of the DFK International World Body of Accounting Firms, which gives us affiliates in 80 countries and 180 firms to handle extra services or needs if we need. Friedman LLP has 20 affiliated firms across Canada with over 600 additional staff we could rely on if we need be. So with that, I would like to introduce my panelists for today's show. Ed Bechold, CPA, audit partner of Marcum LLP. Ed and I have worked together in the past and we're very friendly colleagues, friends. We've been out socially and it's great to have Ed on my panel. Ed, take it away.
Thank you, Neil. Appreciate for the kind words and introduction. Good afternoon, everyone. Happy to be on this panel. As Neil mentioned, I am an assurance service partner at Marcum LLP in the New York City region. I handle about 80% of my practice is public companies, whether they're listed in the United States or Canada. And the other 20% of my work, I deal with private equity fund work. So I've been at Marcum a little bit over 5 years. And as Neil mentioned, prior to that, I spent about 10 years at Friedman. And I think towards the last 3 or 4 years, Neil and I worked quite a bit together, actually, traveling the country and enjoying ourselves and getting into the occasional trouble and getting a lot of work done. So it was definitely a great time in my career to be working there with Neil. Marcum LLP is a national and international accounting firm. We have over 2,500 professionals. We have over 200 publicly traded clients, and they're listed on the New York Stock Exchange, the Amex, NASDAQ, TSX, TSXV, CSE. I think we have approximately 40 offices. We have offices in China. We have offices in Ireland. We have an international accounting affiliation network with a place called Ecovis and the Leading Edge Alliance. And we have primarily a tremendous amount of expertise in the companies that are listed to be at the conference this week. We deal with a lot of technology companies. We deal with a lot of cannabis companies and some digital asset companies as well. So it's a pleasure to be here. It's a pleasure to be with Neil again and everyone on this panel. And that's about it.
Great, thanks, Ed. That was a nice introduction. Next on my panel, we have Wesley Ramjeet. Wesley and I have had the pleasure on serving on some of these panels in the past. Wesley is I would call him an investor in many public companies and companies that are privately owned looking to go public. Wesley is also the CEO of PPMT Strategic, which provides accounting, CFO services, and additional accounting that many of our Canadian companies coming here would need, so the audit firms can remain independent. Wesley and I have had many dinners at prior SNN events in Las Vegas. I've met his wife, and we've had a very good relationship over the years, and he is a referral source for both Friedman and Marcum. So with that said, Wesley, take it away.
Hey guys, Neil, thank you for the introduction. Always a pleasure to be with you on any panel. And you know, the one thing I missed about Vegas this year, we didn't get to go out, but here we are.
Yeah, we didn't get to Joe's Stone Crabs, I know.
That's correct, that's correct. So I'm actually a CPA by training. I spent my first 10 years of my career with Ernst & Young in New York. I did a lot of their strategy work, IPO and venture capital investment. I founded PPMT Strategic Group about 20 years ago. And it's sort of an interesting take in terms of the middle market venture space. Because we started out as consultants, mostly our management team was made up of CPAs and entrepreneurs. So our perspective when we talk to prospective clients or situation, it's really from a management point of view. And you know, we typically work with companies that are sort of in the middle market venture stage because of all the resources we have to help them get to the next level. The spaces that we have a lot of expertise in, it's in media, entertainment, tech, biotech. We've done deals in other spaces, but this is sort of our core competence. And as Neil said, we invest in companies as well, besides providing CFO services and management consulting services. We also invest in companies that, you know, we meet either providing services or at conferences. Actually, my two best investments came out of the SNN conference in Vegas for the past few years. We tend to look for, you know, strong management teams, strong products, and sort of match it with sort of our management team along with our network to see if we can take a product, a situation, a service to the next level. And we're based in New York, and we also have an office in Miami. The spaces that we like to invest in is biotech, health and wellness, and technology. And that's it.
Thanks, Wesley. That was great. Our third panelist is Brian Kearns, who happens to be my partner in the audit business at Friedman LLP. I think around 5 or 6 or maybe 7 years ago, we were able to pry Brian away from Deloitte, one of the big four. And Brian handles some of the largest engagements that we have. So with that, Brian, I'll turn it over to you to tell everyone about your experiences. Thanks.
Thanks, Neil. As you said, I've had the privilege of working with Neil for about 6 years now, since 2014. I spent the first 13 years of my career over at Deloitte on the East Coast here, from Baltimore, Philadelphia, and all the way up to Princeton. I primarily work on the SEC clients here at Friedman in the Marlton office here, doing a lot of roll-ups and IPOs. Done a IPO of mixed martial art companies where they did a roll-up of about 13 different companies, took them public. Doing some e-gaming stuff right now. So we run the gamut here. We do a whole bunch of different types of clients, do a lot of technology, doing another roll-up right now of some health companies. So that's kind of what I do here at Friedman. Thank you.
Thanks, Brian. Okay, so what I'm going to do is I'm going to ask some of our panelists some questions relating to accounting issues. I want to keep this as lively as possible. So once a panelist gives an answer to one of my questions, if somebody else wants to jump in and add something, that would be appreciated. And we'll keep it friendly as we have in other years. So
I just want to wish you luck, Neil, for trying to keep an accounting panel as lively as possible.
thanks, Ed.
If there's anyone that can do it, it's you.
I know this isn't the Allman Brothers in New York. I get it. So anyway, Brian, I'm going to start off the panel with you. Most Canadian companies that dual list here in the U.S. find themselves starting on the over-the-counter market called the OTC. Usually not NASDAQ or New York Stock Exchange first. Can you explain briefly the three levels of the OTC market groups, which are the OTC QX, OTC QB, and the pink sheets?
Sure. So like you said, there's the three different levels here. The QX is kind of the higher end market and listing there. Typically, these are stable companies. They have been around for a while. They've got operations. Typically, they've got requirements to have audits done every year, not just posting financial statements, but actually having them doing a full-blown audit. They're required to have at least 2 independent board members and an audit committee, and they don't typically allow like shells, penny stocks, or any kind of bankruptcy clients to be listed on the QX. The QB is more of your development stage companies. They have to be current in their reporting requirements, but their reporting requirements are a management certified report that doesn't need to be audited. They need to have a minimum bid of about a penny, and they have to stay out of bankruptcy. And these are some of your a little riskier investment companies, but again, they're development stage and just getting started. And then there's the pink sheets. The pink sheets are where there's very little regulation as far as reporting requirements. The one thing you have to do is be traded with a registered broker dealer that's registered with both FINRA and the SEC, but that's for any of these companies as well. So that's kind of the overview of those.
Thanks, Brian. And I think there's over 10,000
yes.
companies, something like that, that trade on these pink sheets. So
yeah, there's about 10,000 registered on the OTC. I think it's only around 600 though that are on the QX, and around 400 or 500 that are on the QB, and the rest are all on the pink sheets.
got it.
Right. There's a new rule coming out for the pink sheet companies that if they don't meet the standards to go up to the QB exchange, essentially they'll go dark. The SEC is going to basically delist them permanently. So that's coming in January. So it'll be interesting to see what that 10,000 company database looks like after this gets put into effect.
Yes.
Got it. So Wesley, talking about that, what type of exchange would you choose depending on what type of company you're dealing with initially.
Okay, so that's an interesting question, right? Because, but I do want to go back to Brian's, overview of the OTC markets. I think one of the reasons why you see a lot of the Canadian companies come to the OTC market to start out, it's a very easy process to get traded on the US exchange. If you're filing on a Canadian exchange or their equivalent to our SEC, which is CDAR. Once you're filing financials with CDAR on a regular basis, all you need to do is get a 152C11, which is a form filled out by a broker dealer, and get a symbol, and you can start trading in the US. It's that simple. And that's why initially you saw a lot of these companies coming to the US. The issue now is sort of, okay, so now you're on one of these exchanges, what do you do, right? Because now there's a cost to being in the US, because OTC markets for the QX, I think the fees are going up this year. It's probably going to cost you initially 20 grand. On the other on the higher version, it's probably closer to 30. So as coming back to your initial question, Neil, it's what exchange do I pick? It really depends on what stage I'm at as a company. If I'm a company that's just trying to figure out my shareholder base and I don't really have a solid business plan, I'll pick the pink sheets because it doesn't cost me anything. And I can try and develop a database of shareholders and then uplist to, QB or QX. Now, if I'm more of a established company and I'm looking for some credibility, then I'll go up to the QX. QB, if you're a venture stage company, couple of million in revenue, maybe you start there, but more established company, I'd want to be on the QX. But one of the things I noticed this past quarter, I'm seeing Canadian companies starting to look at the NASDAQ directly as opposed to making that initial step and then uplisting. And I think part of that is because the NASDAQ market has been so hot this year that if you're in a sector where you're in the electric car business, or you're in remote monitoring software, or you're in a sector that is, going every day, the industry goes up, you might get lucky, find the right banker to take you public on NASDAQ. So I would rule that out over the course of the next 6 to 9 months, because these companies are starting to get interesting for the right industries.
Got it. Thank you, Wesley. So that brings me to Ed. So Ed, what audit firms should these Canadian companies look at? Can they deliver a PCAOB report? Talk about the need to change firms, and talk about what you and I have been seeing, like why choose a Marcum or a Friedman? You may get into some of these smaller firms just don't have the resources or the quality. And I just want to say we've picked up a job right now where we're doing a re-audit for, 2 or 3 years for a huge entity that went with a firm that wasn't qualified. So with that, I'll let you speak about some of the.
Thank you, Neil. I think it depends where the company is in the life cycle, which is sort of touching on something Wesley said before in terms of who do you want to pick, to be your auditor. If your intentions over the short term are to stay, short to medium term, are to stay listed in Canada and not to move on to a national exchange like the NASDAQ or the New York Stock Exchange, then it may well be in your interest to use an accounting firm that's primarily out of Canada that can deliver to you, the audit report that would be necessary, Canadian auditing standards. If in your future you're expecting at some point to uplist in the United States, be beyond the OTC. And the reason why I say this is, Wesley, you mentioned how easy it was to list on the OTC, and that's very true. You can uplist with the financial statements that you're issuing in Canada, which would theoretically be under IFRS standards. There's no requirement to convert those to US GAAP. But if you're going to uplist onto a national exchange, you're going to have to convert your financial statements to US GAAP. And not only that, your auditor needs to be in a position to issue a PCAOB opinion. Marcum can do that. We can do both. If you're starting off on the CSC or the TSX, we can issue audit reports in accordance with Canadian standards. And when you move to uplist, we're also obviously PCAOB registered. I think in my opening remarks, I mentioned we had over 200 US registrants in the US. We're in a position where we have expertise in IFRS and US GAAP. And we have lots of clients that have to go through that or have gone through that transition. And that's why you would look for the expertise for us, because of our ability to pivot to the needs of the company. And that's very, very important, because if you are using a local auditor, a local Canadian auditor that can't do that type of work, or will refuse to do that type of work, you could be starting from fresh start with a new auditing firm to accomplish those goals. So those are things that you really need to consider when determining, which accounting firm you want to be doing business with.
Right. So you started mentioning some of the problems.
Yeah.
Do you have any additional problems from an audit perspective when dealing with the PCAOB beside the audit firm?
Yeah, absolutely. I'm glad you brought that up, Neil. When you're going to switch from Canadian auditing standards to PCAOB, certainly there's a higher threshold from an independent standpoint. And in fact, when I have a couple of engagements that are listed in Canada, and we employ PCAOB standards so that if the company does intend to uplist into the United States, there's no issues with any sort of independent standards that we need to deal with from that perspective. And a PCAOB audit is different from an auditing standard in Canada or even in the United States. The scrutiny level, it's certainly more intense. I'm sure Brian would agree with that as well. The documentation requirements are higher, and as I touched on, the independence issues are more important. There's a higher level of scrutiny dealing with the PCAOB. We're annually inspected. Neil, what is Friedman still every 3 years?
Yeah, every 3 years. We've got about 80 something registrants.
You're almost there.
We try to stay under the 100 so we can concentrate on doing business.
Your client acceptance procedure goes through the roof when it's client number 100, huh? That client really got to be worth it.
It better be worth it, yeah. So thank you, Eddie. So let me move on to Brian.
Sure.
Ed brought up, the IFRS, the IFRS reporting. So Brian, What can you suggest to a Canadian firm about converting their financials? What do we usually do when, we, as the independent auditors, we are prohibited from writing financial statements. So I'll let you take that away of some of the pitfalls or things that they would have to look at.
Sure. I mean, if you have somebody in-house that knows US GAAP, that's great. But for most companies that are coming over, they'll be hiring a consultant to help convert their IFRS statements into US GAAP statements. And one of the things you want to be careful of is just making sure you're choosing the consultant that has done this before with a public company. You don't want to be, choosing the firm just for its price. You want to make sure they've got a lot of experience with US public markets, knows what they're looking at, knows how to, knows what all the issues are between IFRS and US GAAP, and also knows what the auditors are going to be looking for. One of the things you may want to do too is actually just talk to your auditing firm and see who they work with on previous clients, because we've got a lot of experience working with various consultants, and some are good and some are not. The consultant really is going to be the key to getting your IPO or your launch on the U.S. market done timely. The better they are, the quicker your process will be, and the worse they are, the longer that audit process will be. Auditors, we typically like to get a ready to audit package, and that's what we build our budget on, and that's what we build our timeline on, as far as how quickly we can get it done. And when we get a package from a consultant that's not up to par, it extends the timeline and extends the budget. So really, paying close attention to their qualifications and listening to your potential auditors about their experience with these consultants would be helpful.
Got it. And we've seen some enforcement actions against accountants who are not independent. They draft financials, and we see it less and less, but firms like Friedman and Marcum abide by the correct rules, and we protect our clients and they protect us. We do it right. So Wesley, with that, I want to move on to, since we're talking about the OTC markets and resources, but before I get into resources, I want to ask you about trading. I mean, lately I've heard it's been more difficult to trade your OTC stocks, getting a broker to handle that. Many of the guys we used to know, Alpine, Core, they're just not around anymore. So I wanted you to speak about, the liquidity, the availability to trade, and what kind of resources a company would need really to trade here.
So in terms of trading, you're absolutely right. If you're a pink sheet company, an OTC market company, getting a broker to take notice of you and take you on as a client is challenging. But more importantly, 10 years ago, we probably had 5,000 to 7,000 small broker dealers that just dealt with this market. Now I think we're probably down to 1,000. So just by sheer volume, there's not a lot of broker dealers out there to take these companies on. So, part of making the transition into the US, you need to do your due diligence to find that broker dealer that believes in your story, believes in where the company is going to take you on. Because to even trade here, you need a broker dealer to fill out your 15(2)(c)(11) to get you to start trade. And you also need to raise money. That's one of the reasons you're coming here, right? So you would need an investment banker / broker dealer for that. So one of the things that a company can do, it's one, finding the right company, but also wrapping up their investor relations. And you hire a firm, but also attend these conferences that for investors, where you can meet a lot of investors, because sometimes you don't need to raise money in the company. You just want to get the stock to trade properly. And a lot of times at these conferences, I might not invest in a company directly, but if I like the story, I'll go buy the stock on the exchange. So I become another shareholder for them. So typically, if a company can get their shareholder base of over 500, now you start to develop a real market in your stock. And raising money becomes easier because the money that plays in this space, they look for liquidity. So if you can prove that your stock's liquid enough, you'll get money. You'll need to negotiate the terms, because some of the guys playing in this space, they do the, toxic type financing. So you'd have to filter that out. Or it might be a necessary evil, depending on where you are. So, you know, but there's no, it's not what it used to be 10 years ago, but there's still market there. There's still active investors. There's still active broker dealers. You just have to find out.
Ed, we talked about a little bit about independence issues by not being able to draft financial statements. But I know there are some other independence issues that the SEC and the regulatory bodies are really honing in on a hot topic. So I thought maybe you'd get into that a little bit.
Yeah, I mean, independence is always, a hot topic. It's, it's the cornerstone of the credibility of our profession is the, idea that, we're independent as it relates to our client. So we're in a unique position, to certify their financial statements so that, that they're fair and reasonable and a basis for a user to make a financial decision one way or another. There's certain carve outs from, the independence language that you're allowed, to do from a PCOB perspective. You're not allowed to be involved with the tax provision preparation, but you are allowed to prepare, the tax returns under PCOB independence standards. You're not allowed to draft financial statements. That's the company's role, management's role. Typically in the space that, Neil, that you're in and I'm in, generally there's a third party professional financial consultant that comes in to prepare them. Obvious independence issues is, you're not allowed to be, you're not allowed to hold shares. That type of independence is no different with the AICPA, but it can go further. And I'm not sure if you're familiar with the independence case where a former Big Four audit partner was vacationing with the CFO of one of their registrants, and in fact had a little bit more of a professional relationship with the CFO, and that came down as an independence issue. They'll bring the regulatory bodies will certainly will attempt to bring more perceived independence issues if they believe that, potentially the engagement partner or the engagement team has crossed a line. So there is, I would say, a lot more scrutiny, intense scrutiny from an independence perspective when you're dealing with a public company or a PCOB audit for anything. So it's a very, very important issue in our profession. So it's good for, really clients or any, prospective clients that, will be looking to perform this type of engagement, a PCOB engagement. It's very different. And a lot of these rules all came out of, the issue with Enron and, WorldCom and all these different clients that were associated with Arthur Andersen, former accounting firm. And they're in place to ensure, credibility in our profession and that we're, trustworthy in terms of the work that's performed.
Thank you, Ed. So now we've talked about some issues with independence. Let's talk about how do you go public, Brian, in the U.S.? We used to start out years ago with reverse mergers and then alternative public offerings and they called hostile takeovers, but maybe you just want to give a little blurb on what are the types, instead of a dual list, that if you're already in Canada, let's say they just wanted to start off here. So what are some of the ways you can go public here?
Yeah, sure. I mean, the typical way is, you file an S1, you do an IPO. And that's the most common one that people know about. And it's the most, friendly from the SEC perspective. That's what they're expecting most companies to do. So they're helping you along the way with those sometimes. Then you have your reverse mergers, like you mentioned, where there's a publicly traded shell company that doesn't really have any operations or very limited operations, will go through an acquisition of a private company that wants to go public. And in those cases, it's kind of seen as a shortcut to the IPO process. It's a little cheaper sometimes and a little faster, but gets a little more scrutiny from the SEC in their review process. Then you've got something like a SPAC. SPAC is a specialized company that is formed by investors. They put in money ahead of time with the purpose of that company buying a company in its mission statement, saying, okay, we're going to go get raise $100 million, and we're going to go ahead and buy a company in the Bitcoin industry or something like that. And those, what you have that's nice about those is that there's already an established market. There's already an established set of investors available for that. The problem with the SPAC, though, is that the SPAC is the one that has to be kind of looking for your company and looking to buy somebody like you. Whereas with a reverse merger or an IPO, you can make the decision to go public yourself. And then you've got, you mentioned the alternative public offerings. And these are kind of a reverse merger shell company, but also one that has a pipe along with it. And a pipe is one that's got a private investment of public equity. And so these are also seen as a quicker, more attractive way because, again, there's already a market for these. There's already investors out there that want to be in this company because they've raised the money ahead of time. And so those are, some of the typical things that we see in going public in the U.S.
Thanks, Brian. And with the SPACs right now, they're hot as can be, but we've gotten calls with startup companies and they go, hey, I want to do a SPAC. But really, the SPAC is looking for a mature company that they can make a big investment in and something that's making money. So I just wanted to throw that out there.
Yeah.
And okay, moving on.
There's one.
Yeah. Go ahead, Wesley.
Sorry. No, there's one other thing I wanted to add. So a lot of times private companies, whether they're in Canada or US, they have a great operating team, but they really don't have that C-level suite and the need to access capital. So one of the things that we've been doing with our clients and investments, we find well-established public companies that's on the NASDAQ or New York Stock Exchange and merge them or have them acquired. So the management team stays intact to run that business. And now they have the capital to grow it to its full potential. So I think, a lot of companies look to go public but they really shouldn't be public on their own. So this is a good way to solve that problem.
On that topic, Wesley, what about the audit committee? How important is that? And corporate governance from your top management?
So I've been a CFO for a NASDAQ company before. And I can tell you that the larger companies, they really understand the importance of audit committees, internal controls, really, the governance. The smaller company, not so much, because your typical CEO of these smaller companies, they have a lot more important things to do, raising money, staying afloat, all that good stuff. But it's a super important aspect of any public company because management is always focused on the business, getting things done, hitting their earnings number, all the things that take up 24/7 of their day. You need that oversight, not because they're dishonest or anything like that. I mean, sometimes that happens, but for the most part, it's really to make sure they're not losing focus of, rules, regulations, and, what's correct and what's not, right? And if you let companies operate without the oversight, you guys are auditors, so you know this stuff. You'll have, fraud, you'll have, misappropriation of assets. So this is, a key control to have, and you also need the right composition of the audit committee. I've seen some audit committees, these guys can't even read a financial statement. So you really need to have the right audit committee. Like the chairman should be a CPA, a former partner, former CFO, that sort of caliber, so they can have full oversight.
Thank you, Wesley. So I would be remiss if I didn't start speaking a little bit about COVID-19. So, Mr. Bechold, are there any special accounting issues that COVID-19 has presented? Footnote disclosure, going concerns, impairment of assets? I mean, what's going on with the accounting profession these days?
Yeah, I mean, certainly over the last year, there's been a ton of accounting issues, and I'd add auditing issues to that as well. In fact, most recently, from an auditing perspective, we had some issues pop up with inventory observation, whether they were done virtually or in person. That was the most recent big issue. Certainly, there's been a lot more scrutiny in terms of a going concern analysis from a COVID-19 perspective, especially if you were in a gray area in terms of whether or not you concluded a going concern or not. COVID-19 could certainly push you over the edge if your operations were materially impacted from this. So there's been a lot of scrutiny from the going concern perspective, and footnote disclosure that goes along with it. I think almost all my registrants have a COVID-19 disclosure. Impairment of assets, of course, certainly that is something that that's constantly evaluated on a quarterly basis as financial statements are being delivered. But it's facts and circumstances, just like pre-COVID-19, whether or not an impairment would be necessary or not. Were the assets materially impaired because they had to shut down operations? I'm here in New York City. We just shut down all the restaurants, right? Not me. I didn't shut down the restaurants. I wish they were open. But these are all the things that we have to constantly look at and evaluate more closely than we may have in the past.
Let me ask you a question in that vein. So the restaurants have a big year. You've got a $30 million investment. You have to take the impairment at 12/31/2020. And God willing, the thing bounces back June 1st of 2021. Everyone's operational again and making money. Can you reverse that impairment?
And if you were accounting for it under IFRS, there is a path for reversal, but not under US GAAP. So you would take that charge under US GAAP, and that would be it. So it's a difficult proposition, and of course we're always taking the opposite argument of management, right? So someone may come to us and say, well, we want to take this charge because they potentially may just want to write it off the books, so they don't have that operating charge on a go-forward basis, and others resist it because they don't want to take that charge. So that's where the professional skepticism has to come in, and to evaluate how management is determining their position one way or another. So, these annual audits should be interesting in terms of disclosures and impairments and going concern from a COVID-19 perspective. In light of the fact that, like you said, everything's getting locked down, but, hopefully things open back up in May, like you said.
Oh, I hope. So,
Yeah, me
with
too.
the PPP loans, the payroll protection program, I know for tax purposes, we're treating everything that it's going to be forgiven. You could use the expenses. It's like a double whammy. But for financial statement purposes, are you guys keeping the loans on the books until you get the green light that it is forgiven by the bank? Or
Yeah, I mean, our clients, the guidance seems to strongly indicate that those loans stay on the books until such time as they're forgiven. So I have a handful of clients that have the PPP loans, and they'll still be there through December 31st, or at least that's what my expectations would be until such time as they produce the trial balance.
okay, thanks, Ed. Brian, what are some of the differences between, you hear filing as an emerging growth company or a smaller reporting company or confidentiality? What do some of those terms actually mean?
But yeah, the smaller reporting company, it's a company that's got public float of less than 250 million or 100 million in annual revenues and no public float, and they typically get less stringent reporting requirements, less extensive disclosures as they're filing, and then the emerging growth company is someone that's got less than $1 billion, 0.07 in revenue, $1 billion in non-convertible debt in the past 5 years, or 3 years rather, and they can stay in that status for about 5 years or until they trigger one of those pieces there. And the nice thing about the emerging growth status is, your narrative is a lot less. Your disclosures, you're allowed to, or accounting policies rather, you're allowed to adopt accounting policies as if you were a private company, and adopt like 606. You could adopt that when private companies were allowed to adopt it. So it helps you to get public a little quicker, so that you don't have to adopt new accounting standards that you haven't been adopting all along just to get public. You also get a reprieve from having to do the 404B attestation reports until you become an accelerated filer. And you also have like you said, that time where you can file with the SEC ahead of time confidentially, and they can give you feedback on your filing ahead of time, whereas the larger companies don't get to do that. So that's some of the nice things about filing as an emerging growth company or a smaller reporting company.
Thanks, Brian. And Ed talked about some of the accounting firms, why you should use different accounting firms. But Wesley, what about law firms? What about transfer agents? What about IR firms? Are there any differentiations? I mean, what advice can you give some of our Canadian companies that are going to be trading here?
So that's a great question, because every company is different, right? You're in a different sector, you're in a different size, you're a different stage. And my advice to CEOs of these public companies or private companies going public, let's start with selecting a law firm. You want to find a law firm that understands your business, because if you have to sit there and explain your business to them, they're charging you to educate them, right? Same thing with an audit firm. You want to make sure they understand your business. They've done this before. So if you're a tech company, you want to find an auditor who understands tech, If it's biotech, you want to find a firm that understand biotech. Like we had a situation where we had a company we were selling to a public company, and the, the public company wanted to use their auditors to audit our company. And I looked them up. I said no. I went to Neil and I said, this is something that Friedman should do. And he did, because they had the expertise in biotech. And I advise every public CEO who's thinking about this, or private company CEO, is to do your diligence in terms of whatever firms you're looking at. Make sure, talk to the partners, see if they really understand what you're doing, and also if you can work with them. Every partner has their own style, whether it's legal or audit, and you want to make sure you have a working relationship with them. No favors, just good working relationship. In terms of IR firms, there's obviously a lot of IR firms out there. And then there is, companies like Stock News Now, which provides services that issuers buy, or IR firms will go to companies like SNN to purchase. Now, you have to figure out what your strategy is going to be. Am I going to build my own internal team, or am I going to, rely on an outsourced IR firm? And they work the same way, because if you're a very reputable IR firm in media and entertainment, then that's kind of where you want to, if you're a media and entertainment company, that's the firms that you want to look at, not somebody who's doing biotech on the other side. Transfer agents, there are a few that's more reputable than others. It comes down to cost and service, right? So I'm not going to mention any names, but there are firms that we work with that tend to be more cost effective and very helpful. So I would make sure that make those phone calls, talk to your lawyers, talk to your auditors, talk to other CEOs, and see what they recommend to you. But in this business of going public, every decision you make about service providers could cost you a lot of money, or it can save you a lot of money. So do your due diligence.
Thanks, Wesley. So Ed, I want to get off a little shop for a second, but it's a little shop. We talked about SPACs being red hot. Would it still continue? But, I want to tell you from a SEC business perspective, I would say 2020 for Friedman was a very, very busy year with people working from home. I just wanted to know how busy you guys are, and how you guys doing?
We're busy. We handle, just SPAC in general, we handle probably one of the largest majorities of the SPAC practice in the country. We handle a ton of biotech. We do a lot of cannabis. We do a lot of emerging market work. I could say specifically my book of business, they've been raising money like crazy. It was busy all the way through. We were filing registration statements all the way through the end of last week. We were doing, a ton of deal work with all the investment banks that that we run around with a lot. I actually dipped my toe in the SPAC practice group because needed to bring in some additional resources. So it's been really hot. The working from home so far has worked out well. Our offices were open, the soft opening from July 1st to around September. And then we were, officially open from September to, I guess, the first week of December. I'm in the office now with one other partner, but, we're effectively closed through middle of January. And, so far we've been able to manage the workload, but, we're active because our clients are active, thankfully. And we're very happy that that's the case, and hopefully that trend continues.
That's great. So I want to thank my panelists for being on the panel and sharing some of their experiences today. And I'm going to just let each guy just say how someone in the audience can contact you. I'm Neil Levine, N. Levine at Friedman LLP. Eddie?
Edward.Bechold at MarcumLLP.com, or, Google. I assume we could Google everyone on the panel. So,
Yeah. Brian?
B Kearns, Kearns at friedmanllp.com, where you can Google me. I just wouldn't Google Neil. That be a strange search.
That's right. Wesley?
I'm Wesley Ramjeet. It's Wesley, Wesley at PPMTgroup.com. And you can Google me. I'm the only one out there.
Okay, guys. Well, thank you again, Robert Kraft.
Thank you guys. Really appreciate everyone's insights here. We learned a lot today, and we look forward to the next one. Take care.
take care.
Take care, guys. Thanks a lot. Bye now.